Welcome back to New Money. This evening we're discussing retirement and financial planning. My guests are Daryl Bennett and Jordan Toy. And if you'd like to email me, my details appear on the screen. Jordan, let's just talk about one thing. When the rand starts to weaken, everyone starts to panic, want to get money out. However, when the rand starts to strengthen and you talk to people about taking money out, they say, well, let's wait. Wait for what? The rand to come to get better 2 to 3%. So how do you deal with this conundrum with your clients?
Well, I think you've summed it up really nicely there, right? So almost the emotional decision is the opposite of what the rational decision maybe should be. So I think it's first and foremost important to mention, obviously, the rand dollar is or the rand to any developed currency for that matter, is very volatile and inherently difficult to predict, which is sort of arguably what we're touching on here. But that's exactly right. So, when the rand starts weakening, we start panicking, whether it's the headline of the day in South Africa that's driving news or whatever it is that's driving that pessimism. The view is often we need to get money out of the country and invest offshore, but often that's taking place at not a great rate or not a great time because of where the headlines are and where the rand dollar has gone to. So I think it's important, and we look at this not just from the rand dollar, but all the investments we manage for clients and the financial advice that we provide to clients is to try and as much as possible.
I think you're right. It's not a rand.
Yep.
It's what are you going to do with those rands converted to a foreign currency.
Exactly.
But don't you think this is a good time for people to actually be taking money out?
So if we look at the longer term track record of the rand, it's sort of depreciated on average 6% a year. Maybe that changes going forward with a different Reserve Bank inflation target. But in periods of relative rand strength, it can make sense to move money offshore. I think it's more important, how does that fit into your plan? It's not necessarily reactionary where we waiting around and the rand suddenly improves and we're changing the whole plan. If it's part of your plan to increasingly move assets offshore, then yes, when a good rand exchange rate presents itself, take advantage of that. But I don't think it's a case of sitting day to day and sort of hoping for a decent exchange rate to present itself, and that frames the whole plan. I think we try and as much as possible, and I'm sure you do the same with your clients, is to remove emotion from this decision, right? So it's inherently a very emotional decision when the rand is sort of weakening and there's a lot of panic in the air. I think that is very key for us. Is what does the plan say? Let's try and remove emotion from this decision. Okay, no, the rand is not at a good level. We'd rather wait until next month when you've got sort of these planned tranches going offshore.
Daryl, I have a different type of view. I mean, if you're looking for income, stay in South Africa. There's no doubt about it. You're not going to get better returns out of government bonds and all the different investments you can make. But when it comes to investing for long-term growth, you've got to say, where best will I get that return? Where is money being spent? And what are the type of companies I want to be invested in? How do you analyze those two?
Well, no, but to your point, and if those companies aren't on our market, because it's no indictment on South Africa, it's just that it's not on our market. So if you go back to AI and take AI as a theme, and you look at the top companies that support the AI theme, they're not on our market. So whether you lived in South Africa or New Zealand, which is a stable country, you will want to invest in the NVIDIAs, the Microsoft, the Googles, Amazons, because those are the companies that are driving this whole AI growth. Those are the companies that have got the deep pockets. Those are the companies who are putting a lot of money in R&D. And because those companies happen to be predominantly in the USA, which is dollar-based, well, then that's where your rands need to go. So, when it comes to the rand, there are also smarter people than you and I, the far corners of the world, that can manipulate and sell the currency or buy the currency, because it's a very liquid asset and it's a very liquid currency. So it's where your money needs to be if you're looking for growth, and that's not particularly on our market.
Yeah, when you talk about where does your money need to be and the currencies, I mean, the rand has weakened or strengthened a lot against the dollar, slight strengthening against the pound, few percent, and the euro. But people mustn't mistake. The fact is, the companies that you talk about listed in America are not American companies.
Exactly.
They're global companies. Yes. They just happen to have a listing in the USA. Daryl, let's just talk about interest rates, because, if you look at the two-pot system, 57 billion in the last 12 months has been drawn from pension funds. And this is people who have jobs, because the only people who are contributing to pension or provident funds are people who are working. So they can put bread on the table. They can have the basic foodstuffs. And they've drawn 57 billion and paid something like 14 billion in tax. It's astronomical. So the question is, What is your view about interest rates? Because I have a strong view. I think interest rates should be a lot lower. But the Reserve Bank, and we're not economists, the economists may be saying, yes, it's right, protect, I don't know.
Well, they're this inflation targeting, and they do follow the Fed at the end of the day. So, they look to the Fed as a barometer. I think interest rates might come down slightly going into 2026. But once again, you don't want to get lured into a false sense of security, putting your money in the bank, money market funds. This happens all over the world. It's a behavioral problem, okay? Because the second biggest risk to capital loss is inflation. So you could have your money earning a yield or an interest of 5% in the bank, but if your inflation is 6 or 7%, you're actually going backwards in real terms.
And it's your inflation.
So exactly.
Everyone's
So
inflation is different, because those that don't have debt have sometimes a higher inflation because they haven't had the benefit of interest rates coming off 5 times, 1.25%. So that's quite important as well.
No, absolutely.
Yeah. Right. So let me just understand something, Jordan, and then we're going to go to emails. The amount of money that's being drawn out of the retirement funds, that's going to have an enormous impact on people who say, I need the money today, retirement will take care of itself. Daryl was talking how important it is we get in earlier, we start saving a lot earlier, because if you start earlier, you're saving a lot less and getting a far greater return than if you start later and you want to save a lot, you won't get that return. So how do you see this impacting on the ultimate retirement benefits that people hope to achieve?
I mean, there's no two ways to look at this, right? If you're withdrawing money from your investments that are ultimately meant to provide for your retirement one day, you are putting yourself in a worse position for retirement. There's no other way to look at it than that. That is the reality. I think what I've been focusing on recently, and I think we've talked about it on your show over past shows, is that what is that money being used for? So, all right, assuming that the withdrawals are done and dusted, the money is out of your retirement account, what are they being used for? And I think one thing that I zeroed in on is, a big portion of it is being used to reduce debt. And that on the surface level sounds good. It sounds positive. All right, well, maybe your investments are doing 12%, but you're being charged 20% in your credit card debt. There is maybe some rationale for that. But I think what's key is, what are people's lifestyles doing in that whole picture, right? So if you're withdrawing from your retirement account to pay down debt, but are you changing your lifestyle to be more sustainable, or do you continue to spend on debt? Because otherwise we find ourselves in this vicious cycle where, if the lifestyle doesn't change, you can't keep withdrawing endlessly from your retirement account to now settle debt that you're not actually addressing the root cause of. So I've been focusing
a lot
on...
You can draw endlessly, because the 1/3 on all contributions after the 1st of September 2024, you can draw out whenever you want, as long as it's more than 2,000
yes,
rand.
Of course. So I think that's key for me is if you are withdrawing, what are you using the money for? Because if it's to go away on holiday, it's possibly the worst outcome of what you could use those funds for, because 1 rand withdrawn from your savings today could be 10 plus rand in the next 20 years. Maybe in 40 years it's 20 rand. So the magnitude of the damage you're doing to your future retirement outcome is massive. So it is concerning the amount of retirement withdrawals we're seeing, but in the economic environment we find ourselves in, I think it's not completely surprising.
Daryl, anything you'd like?
Yeah, just to add to that is that, and I was thinking about it driving here today, it's so important, we go back to the psychology of money, is that when you're sitting with a financial planner and you take out a budget, don't just do the exercise to tick the box. Don't just do the exercise to put numbers on what you're spending on food and rent and education. Use it as an exercise to dig deep to understand what you want your money to do, where you want to go in life, what are you spending it on, why are you spending it on that, and use that budget as a serious exercise to help you with your retirement plan. And as Jordan says, don't just take from the retirement fund to offset debt every single year. If you're serious about getting rid of debt, then put a debt reduction plan in place. And ultimately debt destroys wealth. So the sooner there's good debt and there's bad debt. So as soon as you've got rid of the bad debt, then it's okay to have taken it out of the retirement fund. But it's important to understand where your money is going and where you want your money to go.
Darren, I love what you say, is do that budget not just for the sake of the number. Do that budget to interrogate what do you want to do with your money. And if you want to reduce debt, don't just go straight to the fund. Actually start looking at your budget and saying, right, where can I shave money? And it's amazing how you are able to shave at all different places. It's just about the need. I just want to go to a couple of emails. Paul in Howick says, and this one's for you, Jordan, how do I calculate how much life cover I need to protect my family?
So the first part of that calculation is relatively straightforward. Do you have a bond? That's one of the critical things to cover. So let's make sure whatever the outstanding value is on your bond, that's covered.
Bond or any other debt?
Yes, bond or any other sort of debt, major debt linked to property, let's say. Second one would be if you have children, their education costs. Let's make sure that if, whatever age they are, you plug in some estimates of how much you think it's going to cost you to put them through whatever education level they would like to go to. That's the second thing.
And some policies actually extend to educational costs.
Yes, and that leads nicely into the next point I was going to say, which is as you age, potentially illness becomes an issue. So not that a life policy replaces a medical aid, but you can have severe illness benefits linked into that to help cover some of those areas. But the key for me is children's education, debt, as well as your family. Let's assume your children start working. Do you have a spouse? Do they not work? You have to factor in that they may need some income if you're not around anymore. So those are kind of the key elements that you'd need to, some of them you need to try and estimate today's value or a present value of the future cash flows, plug all that in, and then also allow yourself some margin for error. So sort of take that sum insured that you've worked out and potentially do you add 10% to that to just allow for some slippage or some error in your estimates. But those are the sort of main areas.
Yeah, the debt and education costs are objective. Clearly calculate. What's not objective, which is more subjective, is how much does my family need and how do I hedge against inflation and do they eat into capital, all those things that go with it, Daryl.
And you've got to marry the affordability with the risk. At the end of the day, we're in the business of risk. We manage the risk using life insurance and investment products, and you've got to find the balance.
Well, guys, we've got so many other emails. I'm going to get a lot of calls now, as I always do when I don't deal with the emails. You didn't deal with my email. I'll maybe send them through to you. I'll do them myself. It's virtually impossible to lock in a financial plan from the very first day you start working. It's life-changing, and as events occur throughout the years between your first job and eventual retirement. Everyone's circumstances are unique, so it is essential to assess your own situation to determine your financial needs in the years ahead. There are two focus areas in financial planning. Firstly, providing peace of mind and maintaining your family's lifestyle, and two, creating and preserving wealth for the long term. It's important to understand this distinction from the outset and to be clear about your goals. Do you want protection in the event of death or disability, or do you want to ensure you have sufficient funds to retire on? Your answers will help both you and your financial advisor to fully understand your objectives and establish the appropriate solutions to achieve them. I'd like to thank you, Jordan and Daryl, for joining me this evening. It's important to note that our program is to provide information and should not be construed as advice. Next week's program will once again be dealing with healthcare, with what's happened with the increases, and if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.